Take a look at this chart. A currency pair is plummeting in freefall. Down below, your standard oscillator hits the absolute bottom of its range. It flashes oversold. For an intermediate trader, the instinct is immediate. It's time to buy. But instead of bouncing, the price keeps dropping. Buying right here is like trying to stop a freight train by standing on the tracks. The market is in a roaring downtrend, and your position is wiped out in seconds. The error is treating an extreme reading as an actionable signal. It isn't. When a line hits the bottom of an indicator, it merely confirms the market is stretched. It tells you absolutely nothing about when that tension will actually snap back. To stop catching falling knives, we have to look past the raw price drop. We need a way to measure the actual force pushing that price down, the underlying momentum. Finding that exact moment when the selling pressure finally exhausts itself requires a specialized tool. It requires the Williams %R. Developed by legendary trader Larry Williams, this indicator was built to solve the precise timing problem that has frustrated traders for decades. The formula identifies the highest peak and lowest trough over a period, then measures where the current closing price sits within that bracket. The scale is inverted. 0 at the top is maximum bullishness, -100 at the bottom is total bearish control. Here, the trap springs. The line dips below -80. The asset is technically oversold, and amateurs buy. Professionals wait. The high probability buy signal only triggers when the line reverses and crosses back up above the -80 threshold. You aren't guessing when sellers tire. You wait for mathematical proof that buyers have resumed control. The true power of the Williams %R reveals itself when chart price and momentum data completely disagree. We call this divergence. In this chart, a clear downtrend. The currency pair hits a low, rallies briefly, then collapses to a new, deeper low. But look at the momentum line below. During that second collapse, the indicator fails to reach its previous depth, forming a higher low. The price chart looks incredibly bearish, but the downward momentum is dying out. Sellers are pushing the price to new depths, but with a fraction of their previous force. The inverse occurs at the peaks of roaring bull markets. A bearish divergence flashes when the price hits new highs, but the momentum indicator forms lower highs, warning that buying pressure is running on fumes. Divergence acts as an analytical X-ray, letting you spot a trend's structural weakness well before the rest of the market realizes a reversal is coming. Because it calculates based on past data, Williams %R is a lagging indicator. In sideways, choppy markets, its extreme sensitivity will generate premature signals. To filter out the noise of a real trading environment, you have to build a protective shield around your signals by layering your analysis. Start with a secondary trend tool. Here, a Williams bullish divergence aligns perfectly with a bullish MACD crossover. Your final execution trigger is price itself. Wait for a definitive pattern, like this massive bullish engulfing candle, forming exactly on major support. Even with stacked confirmations, trades will fail. Operating in momentum markets requires absolute discipline in your risk management. If you are trading a bullish divergence, your stop loss has a clear mathematical home, exactly below the absolute lowest wick of the pattern. There are no perfect indicators, but when you combine the Williams %R's early warning system with strict confirmation and disciplined risk management, you turn chaotic market noise into a distinct high-probability edge.